Hey everyone, and welcome back to another video for today. So let's talk a little bit about OSCR today, just to revisit what was said a month ago. By the way, OSCR, the stock, is back to prices not seen since a month ago, basically. Okay, it's back to prices around $14, where previously $14 was a type of support back in May and June. Now, let me be very clear here. One, I still have a position in OSCR. Two, I don't plan on selling my shares anytime soon. Three, you have to know what you own. Okay, I've been very clear from the start. This is an industry that is very complicated. The only reason that I decided to jump in is because I trust the CEO, as I've shown you in the last video, and I'll show you again in this video why that's extremely important. Number 4, at the end of this month, in July, we're going to have United Health Group and Centene report earnings and provide probably some guidance. That's going to be very important. Number 5, at the start of August, we are going to have OSCR earnings report and guidance. That's also going to be very important. And as I said, I don't mind having a small position going into the earnings report, because when we go into the earnings report, as a, let's say, new investor in a company, we are willing to pay the price to get more information. Even if the stock jumps after the earnings report and the earnings call because they provided good guidance, it's not as bad as expected, they provide us more color on what's expected for 26 and maybe 27, because they did give us guidance previously for 2027, then yes, maybe the stock will jump. And so you might say, oh, but wouldn't that be too late to buy? No. Is your investing horizon a week, a month, or is it a couple of years' time? Because if you liked buying OSCR at $20, at $18, maybe even at $22, then you should love buying OSCR at $14. But if you do not like to buy OSCR at $14, then you should have never bought it at $20, because I can be 100% correct here when I'm saying that if you bought it at $22 and you hate it right now, you didn't buy a business. You bought a ticker and a number that kept going up for a couple of days, and that's the only reason why you bought it. And so if you are in that group, yes, you should definitely sell your position, because you own something that you have no idea what's going on. That doesn't make any sense. That's gambling. And for gambling, as you know, we go to Vegas. It's much better. You get free drinks and all of that. So why even bother here? But for those of us that do see a very good business here, do see quite a lot of opportunities, quite a lot of upsides, then yes, patience. Patience is necessary here. You of course have to know the risk. Same with every other investment out there. So let's revisit OSCR in this video. If you enjoy this type of videos, hit all the buttons, especially the red one, very close to 100,000 subscribers. So who knows? Who knows, maybe when you're watching this, when you hit that button, poof, 100K. So do me a favor, hit that button. And if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so OSCR right now, by the way, after hours, it's already up 1.6%. So we're back above $14. This is a company worth around $4 billion, let's say around $4 billion, and they are expected to generate around $11 billion this year. Okay, so if you want to do here your price to sales or your EV to sales, yeah, it's way less than 1 times. Of course, that makes sense. Now, this is also a company that currently, based on the analyst expectations, is only expected to grow revenue forward 2 years compounded, 9.2%, but EPS is expected to grow 226.3% compounded for the next 2 years. Okay, currently the market expects for fiscal 27, as I'll show you, around $2 EPS. The company is expecting more than $2.25, meaning that you're paying today around 6.2 times 2027 earnings for a company that is growing this quickly. Does that make any sense to you? To me, it doesn't. Now, as you know, things can change. Right now, all of these forward pricing multiples, right, across the board are based on analyst expectations, right? Whether it's EPS, net income, revenue, those are all based on analyst expectations. And so if the analyst expectations come down or go up, that pricing multiple will change. Of course, the same thing goes here if the price goes up a lot or goes down, that pricing multiple will change as well. Now, what did Oscar tell us last quarter? They told us the following: we delivered continued top-line growth and bottom-line performance with significant year-over-year increases in revenue and net income. We continue to expect meaningful margin expansion this year as we deliver superior value to our members and partners. And here you can basically see the huge increase in total revenue. Medical loss ratio has come up a little bit. That has been an issue across the board, across the industry. We've heard that from United Health as well. SG&A expense ratio is coming down. That's actually expected to come down even more on a full year basis in the coming years. As for guidance for the full year, this was the number that was given last quarter. So revenue between $11.2 to $11.3 billion. 2024 ended at $9.17 billion. So they expected to add another $2 billion in revenue this year. Medical loss ratio between 80.7 to 81.7%. Last year, 81.7%. So that's expected to come down. SG&A expense ratio in the range of 17.6% to 18.1%. Last year was 19.1%. So that is also expected to come down. Earnings from operations in the range of $225 to $275 million, and adjusted EBITDA is expected to be roughly $140 million higher than earnings from operations, which of course is much higher than what it was last year. And if we look at adjusted EBITDA for last year, that was just under $200 million. Now, a couple of extra things here. One, institutional ownership for Oscar Health has been increasing. And this is the CEO that we have right now. He spent 4 years at Cigna and he spent 15, almost 16 years at Aetna. Okay, this is also a CEO that has returned insane amount of value to shareholders. And in his tenure, the shares rose around to $200 or so. At one point, I think he said it in the latest interview, at one point, one of their biggest shareholders came to them and said, look, we would like you to increase dividends and maybe buybacks as well. And he said, it's actually interesting because I'm actually, planning to decrease buybacks to invest more in the business. And they're like, no, we don't want that. We are your biggest shareholder. You should listen to us. And he's like, if you're not happy with the way that I run this business, then maybe you shouldn't be a shareholder. Guess what? That same shareholder group came back when the stock went above $100 and they said, we made a mistake. Yes, this is the type of CEO I'd like to see run a company like Oscar Health. This is also the type of CEO that before he became CEO of Oscar Health, he said very, very plain and simple, do you want me to come in and flip this business? Basically taking this company, which was worth, I think, $2 per share, $3 per share or so, make it worth a little bit more and then sell it? Or do you want me to come in and actually try and change this industry? Guess what? Well, option 2 happened and he is now CEO of Oscar Health. That's the type of CEO I want here. Someone that is very, very good at what he does in this very, very difficult industry. Now, I've shared this clip before, but I want you to listen to this one again.
Where is the business now on this journey to go? The stock price is higher. I think I saw it around 16. It probably fluctuates, but $16 a share. You got a market cap of about $4 billion. How far along are you on your journey now?
In 2025, our objective is to have, so we made money in 24 for the first time. We made adjusted EBITDA in 23, which is what we told the street. But in 24, we actually made EBIT. We made real money you can count, right? Instead of funny money. And so that kicked it off. This next year, we've promised 2.5% margins to the street in our earnings through the year. And growth of up to 11 billion in premium. And why those two numbers matter is that 11 billion at 2.5% margins in the insurance industry generates a $5.5 billion market cap. We're at 4 point something right now, 4 point low, right? So that's one piece. At 5% margins, you get a 1x of revenue. And so by 27, what we committed to the street is we're going to have 5% margins, real margins, not EBITDA, EBIT, and we're going to have 14 billion in revenue. That makes the stock price of the company somewhere between $45 and $55 a share, depending on the on the PE multiple from where we are today.
And that interview was a month ago. Okay, it wasn't 6 months ago or 12 months ago. That interview was at the start of June. And so to me, when I hear this, I'm like, okay, seems pretty confident. You might say, oh, but maybe he's lying. Well, his track record is pretty good, so I doubt he'll start lying now in 2025, right? He maybe should have lied 20 years ago, but he didn't. Okay, he didn't. Also, when he talks about at the end there, when he talks about what type of PE multiple he could get, in that same interview, he explained why do companies actually get a higher PE multiple. It's all based on trust. This is something he has talked about before, and he's doing right now the same thing. It's building trust, company expectations, and Wall Street. Because if a company like Oscar, right, which is still very young, says that they will do XYZ, but they actually do ABC, then why would Wall Street trust the company? Then why would Wall Street actually put a higher PE multiple or a higher price to sales multiple on that stock? They wouldn't. That's what he says here. We are delivering. We delivered in 23, we delivered in 24, and we plan on delivering in 25. And then he talks about the targets for 2027. So, yeah, if you don't want to be patient, then yes, you'll probably miss here a 3x opportunity. Now, of course, as I said, there are always risks that you have to take into consideration. Big policy changes, ACA subsidies expiring, maybe currently they're not getting extended. That can still change. You still have a couple of months left in 2025 where that can still change. But as they say here, the individual market growth is sustainable with additional upside if enhanced subsidies extend beyond 2025, right? If enhanced subsidies extend beyond 2025. So they see here, without subsidies, this is the total enrolled lives right now, 24 million. So a 2 million increase from 2024. With subsidies, you're adding here another 7 million. Of course, remains to be seen what happens with that. But ICHRA is going to be huge according to them. This is basically ICHRA, Employee Purchases Health Plan. Employee submits proof of medical expenses, including premium to employer, and employer reimburses employee for eligible expenses up to limits set by employer. Oscar does see this as a major growth driver, potentially tapping into a market of 75 million people in small and mid-sized businesses. I believe they also said that if you add another chunk, they could reach 125 million or so. The company believes that the infrastructure and awareness around ICHRA are still developing, but the long-term potential is substantial. They also believe that their MLR or medical loss ratio can continue to come down. They have an around 80% target by 2027, and that one is already coming down as we've seen. SG&A expense ratio is also coming down and expected to be around 16% for 2027. These are basically their expectations for 2027. So they're targeting at least 20% revenue CAGR and 5% operating margin by 2027, just like he just said, with upside if enhanced subsidies are extended, which means that currently, from what I'm understanding here from this sentence, is that their 2027, expectations are as follows, and it can have some upside if the enhanced subsidies are extended. Pretty good, I'd say, no? I mean, EPS here, over $2.25. Right now we're at $14 per share. Like I said, 6.2 times 2027 earnings for a company that's expected to grow like this. I mean, what's not to like? Other than, of course, the uncertainties around that industry, which again, could turn for the worse. But then again, I think Oscar has been saying time and time again that they've been preparing themselves. Or on the flip side, which is the good case scenario here, things are going to work out, and these numbers are actually on the lower end. Because when we look at their key strategic levers to drive approximately 20% top line compound annual growth, we see here that it is including a subsidy expiration scenario, and then we add the other three scenarios, which is expand existing market presence, market and product evolution, and then plus Oscar and investment income. So grow campaign builder and leverage cash position for investment income, and that's how you reach those expectations. So it's not like they're blind and they're really not paying attention to subsidies being expired. No, they know this and they've noted this in their presentation. And so to me, nothing has changed, right? Nothing has changed with the company of the past month, other than the stock going from $14 to $22 and then from $22 back to $14. Okay, I mean, a trader's dream, right? If you bought at 14, sold at 22, you can now buy back at 14 and, well, basically house money. Okay, but for long-term investors, nothing has changed. We are still waiting for the next earnings report, commentary from management to give us a better picture of what's going to happen in the back half of this year and 26 and 27. Like I said, I still hold my shares, nothing has changed, and if I change my mind, which I don't think I will until they report earnings, I will of course let you know. But so far, nothing has changed other than, well, a series of downgrades from analysts, which some of them are horrible. By the way, 1-star rating on tip ranks, only one good analyst here, which again, with the same arguments, which I would still give the company and management the benefit of the doubt until they actually, well, don't deliver. But so far, so good. So all in all, that's about it. Don't panic, know what you own. If you don't know what you own, then just sell. Plain and simple. That's all I've got for you right now. If you enjoy this type of videos, hit all the buttons and I'll see you all in the next one. Bye bye.